Let's discuss the question number 2 here. We have been given the trial balance as on 31/3/2015. Apart from that, adjustments. Adjustments are the transactions not identified just before the preparation of the trial balance and came to know only after the preparation of the trial balance. So as we are aware about these things only after the preparation of the trial balance, we have to adjust these things in the trial balance. Okay, in the trial balance. Of course, we can pass journal entry for all as a normal journal entry. That journal entry will be named as adjustment entries here. Adjustment entries here. Is that okay? Now, adjustment number 1, and then what is the requirement here? Pass adjustment entries. Second, prepare adjusted trial balances. The adjusted trial balance is nothing but after passing the adjustment entries, we have to incorporate those things in the concerned account and then prepare a fresh trial balance. Prepare a fresh trial balance, which is the adjusted trial balance. Practically, we won't prepare the adjusted trial balance, not required at all. For the understanding purpose only, I am going to guide you how to prepare the adjusted trial balance. Adjusted trial balance is nothing but all the adjustments we are supposed to do while preparing the final accounts could have been already adjusted before the preparation of the final accounts. And prepare final accounts from the adjusted trial balance. From the adjusted trial balance, we have to prepare the final accounts. Is that okay? For the stock, what is journal entry? Come on. For the opening stock, that opening stock should be addable with the purchases and closing stock should be subtracted from the purchases to find out cost of sale. Cost of sale. Right. Otherwise, the material meant for sale will be identified. What is the expenses? Is it the purchases or amount of purchases used for sale will be the expenses. If you put that question rightly defined, only the amount of purchased item sold will be the expenses, not the purchases. So we have to adjust the opening stock as well as closing stock with the purchases to arrive the stock supposed to be considered as an expenses here, right? So the for opening stock, the journal entry will be opening stock will be added with the purchases. No, purchases by default debit balance, and if I want to add that, that will be addable with the purchases or debiting it. Okay. So purchases upon debit, purchases upon debit, to opening stock, to opening stock. The value being 1000. The value being 1000 rupees. Is that okay? In case of closing stock, we have to subtract from the purchases, right? To subtract the purchases, that should be credited, and closing stock should be debit. So closing stock upon debit, two purchases, two purchases. This is how we can pass journal entry for opening stock and closing stock. The closing stock value being 3000 rupees. Then outstanding expenses, selling expenses, right? What's the journal entry for that? In case of outstanding, the expenses should be debited to outstanding expenses will be posted here. Okay, selling expenses upon debit, selling expenses upon debit to outstanding selling expenses, outstanding selling expenses. The value being 200. Okay. In case of advanced administration expenses, what you can do? In case of advance, should be subtracted from that expenses. So the expenses usually a debit balance to subtract should be credited here. Okay. So that advance should be now debited. Advance admin expenses should be debited. Okay. To admin expenses. To admin expenses. This value being 400. This value being 400. Okay. This value being 400. Commission receivable, also income. This is income accrued, otherwise outstanding. Income outstanding is an asset for you that should be debited to income. To income. The entry being accrued commission upon debit. If it is an asset, it will be a debit balance, right? Income receivable is an asset. It should be a debit balance. Keep that in your mind. Accrued commission account debit to commission account. To commission account. Especially this commission is an income, right? I'll just put that I in brackets representing that it's an income. 100 rupees. Rent received in advance. Income received in advance is a liability. Liability should be in the credit side. So the rent in advance should be in the credit side, and the rental account will be in the debit side, right? Rent account debit. Rent account. It's not expenses, it's an income. To differentiate the income from the expenses, I put the I after the rent account. Rent account debit to rent received in advance. Rent received in advance. Okay. The value being 200 rupees. 200 rupees. And provide interest on drawings at the rate of 5%. How much is the drawing here? 1000 rupees. For that 5% will be created. We are not aware about the date of drawings. If the date of drawings is not given, preferably the interest on drawings will be calculated only for half year. So into 1 by 2 will be taken. Then the value being 25 rupees. And the interest on drawings just now we have calculated might have not been paid already. Right, so it's an outstanding. So interest on drawings is an expenses, income, right? Interest on drawings and income should be credited here now. So interest on drawings account debit, interest on drawings account credit, okay, and outstanding, still recoverable, okay. To interest on drawings, sorry, so the interest on drawings is an income, so I am crediting it, interest on drawings. The value being 25, and it should be debited to which account? Outstanding interest on drawings. Outstanding interest on drawings is a representative personal account, right? Represents whom? That outstanding interest on drawings. Whom this one is representing? Owner. Owner. It represents the owner, right? Isn't it? Drawing should be adjustable with the capital only. No. The owner is always named as capital. Similarly, interest on drawings is payable to the owner only. The outstanding interest on drawings represents the owner. So I can, rather than put that value being the outstanding interest on drawings account, or directly I can debit the capital account. That way also you can post it. Is that okay? Capital account. Capital account is a direct account, right? Rather than you post that as outstanding interest on drawings, you can debit the capital account here. The value being 25 rupees. I am charging that account. Actually, owner to whom the company is liable to pay 6,000 rupees for the capital. Because of the drawings, we have to deduct from 6,000. Not only that, he has to pay the interest on drawings also. That should also be subtracted. That's why the capital account is in the debit side now. And provide interest on capital at the rate of 6%. Provide interest on capital at the rate of 6%. Here, capital is how much? 6,000 rupees. For that, you have to calculate 6%, which is 360. So, see, you don't need to worry about the half year calculation here. Without the capital, the business will not run, right? So, the capital will exist since the day one. Since the day one. Usually, we calculate the interest on capital for the full year rather than half year. So, we can calculate the interest on capital for the one full year rather than drawings. So, in the case of drawings, we calculate only for the half year, but in the case of interest on capital, we calculate for one full year. The interest on capital is an expenses for us should be debited here. So, interest on capital account debit, interest on capital account debit, and to outstanding interest on capital. Outstanding interest on capital represents whom? The owner. Rather than I credit to outstanding interest on capital, I can credit directly to the capital account. So, to capital. To capital. Okay. This value being 360. This value being 360. Now, 8th one is all about depreciate fixed assets at the rate of 5%. So, depreciation is the loss that should be debited and it will reduce the value of the assets. So, depreciation upon debit to fixed assets will be the correct entry here. Depreciation upon debit, depreciation upon debit to fixed assets, to fixed assets. I'll put that as F dot A. 5%. Here the fixed assets being 4,000 rupees. For that you have to calculate 5%. That 5% on that being 200 rupees. So we have completed all the 8 adjustments. Where in case of stock, always remember we can adjust the opening stock as well as closing stock simultaneously. Apart from that, verify if there is any investment or loan in the trial balance. If the investment and loan exist in the trial balance, verify whether there is any prefix by way of some number. That number represents the interest eligible for that. And date is also given. If everything is given, there is an hidden adjustment. Always cross verify if there is any hidden adjustment or not. So, for example, in this case, we are preparing the accounts for 31/3/2015. It means the account is also being for 1/4/2014 to 31st March 2015. Am I right? This investment originally purchased on which date? 1/1/2014. 1/1/2014. Before this year. This investment is with us for 1 full year. 1 full year. If the investment is with us for 1 full year, this one is eligible for 1 full year's interest. Then interest rate applicable for that is nothing but the prefix with an investment which is 12% for the 2000. Find out the 12% on that. So 2000 is 12%, 240 will be the interest on investment we supposed to receive. Verify if there is any interest on investment available in the credit side. And of course available, but how much is available? Only 100. From this it is very clear, as per our calculation, this investment is eligible for 1 full year's interest which is equal to 240. Currently the interest on investment is only 100. So the difference between these two 140 may be assumed to be the outstanding or accrued interest. Right. So that's similar to commission receivable. Income receivable only, no? So income receivable means you have to pass the same entry like fourth one. Right. Now the entry being interest on investment is an income recoverable, so it should be credited to interest on investment. Interest on investment. This is gain for us. 140. Actually, 240 should be there. 100 already received. 140 is pending. You have to cross verify this. This is called hidden adjustment. And in the debit side, we can name this also as being outstanding interest on investment. Okay, either you can name this as outstanding interest on investment, or you can simply debit to the investment account. Both the way you can post that. So 140. The same logic will be applicable for the loan also. When the loan borrowed only 1/1/2015, it means in the current year almost the last quarter we purchased 1/1/15 last quarter. So from 1/1/15 to the year end, it was held as loan only for 3 months. So this loan will be eligible for only 3 months interest. So 4,000 rupees is the loan, right? So the loan amount is 4,000 and the rate of interest eligible for this loan being 10%, and the loan borrowed is only on 1/1/2015, or we enjoyed the loan only for the last quarter. So this will be eligible for only 3 months interest, right? So the 3 months interest being 100 rupees, am I right? Now verify, is there any interest on loan available in the debit side? No, we don't have any interest on loan in the debit side, so the entire 100 rupees will be now considered as outstanding interest on loan. So outstanding interest on loan is a liability, right? And interest on loan is an expenses that should be debited. So interest on loan upon debit, interest on loan upon debit to outstanding interest on loan, to outstanding interest on loan. This value being 100. So we have almost posted everything. Always cross verify in case of investments and loan given in the trial balance together with the rate of interest being the prefix with the date of loan or investment. And you can calculate from the date of loan borrowed or until the date of repayment. You have to find out the rate of amount of interest, and it should be matching with the interest available in the P&L account with the trial balance. If it is not so, then maybe named as either advance or outstanding. In this case, we have found out the advance means outstanding interest on investment as well as outstanding interest on loan also we found out. We have now passed all this entry. These entries passed only after preparation of final accounts because we came to know these things were missed while preparing the trial balance. If we might have known already before the preparation of the trial balance, we might have comfortably passed the journal entry. But now we are adjusting those things. No, that's why it's called adjustment entry, right? Either maybe named as closing entry or adjustment entry. Now, the next one is all about prepare the adjusted trial balance. I am going to prepare the adjusted trial balance here. right? Now, so we have completed the past adjustment entries, prepare the adjusted trial balance, incorporate all these things, purchase debit, purchase credit. Already we have purchased 5,000 rupees in the debit. Because of opening stock, we debit once again another 1,000 rupees. Because of closing stock, we subtract 3,000 rupees. After these adjustments, the purchases value being only 3,000. Am I right? So the purchases of 5,000 rupees worth of stock, out of that, 3,000 only sold off. Means balance remains as an asset to be usable in the next period. That is not an expenses. Only the purchased items sold will be the expenses. Now we found out how much of purchased items sold in the current year. That can be found out by after adjusting the opening stock as well as closing stock from the purchases. And now we got it as 3,000 rupees, which is the adjusted purchases, also being expenses debited to the P&L. And opening stock in the credit side, already we have opening stock in the debit side. By doing this, the opening stock will disappear. And instead of that, we get a new stock, closing stock rupees 3,000 in the debit side. Rather than this 1,000 rupees, we now get 3,000 rupees. Rather than this being the opening stock, it's closing stock. It is closing stock. Am I right? Selling expenses should be inflated by 200 because of outstanding. Earlier, this is 1,000, now it is 1,200. Am I right? Then outstanding selling expenses, the liability, assets now. There is no such account. We have to open a new account and post that in the credit side as it is being the credit balance in the credit side. Right? So outstanding selling expenses. The outstanding selling expenses here being 200 rupees. Here being 200 rupees. Advanced admin expenses, we don't have such an account. Now I am going to open that one in the debit side. Debit side. So advanced admin expenses. Advanced admin expenses. Okay. This value being 400 rupees. This value being 400. Then admin expenses 400 rupees in the credit side. Already we have admin expenses 1,000 rupees in the debit side. Because of this directly it's a credit, it should be subtracted. After subtracting that, advance means administration expenses hereafter only 600. Hereafter only 600. Accrued commission. So commission accrued. A new account now comes in the debit side. So accrued commission. Accrued commission. Okay. This value being 100. This value being 100. Commission income in the credit side. Already we have commission received 500 rupees. With that, another 100 rupees is supposed to be addable. After this, the commission becomes 600. Rental income debit. Rental income. Already we have 400 rupees in the credit side. Now the rental income is going to be debited because of the advance. It means it is going to be subtracted from the 400. Now it is going to be recorded as 200 only. Okay, 200. Is that okay? Now, rent in advance a new account. Now we have to post that in the which side? Credit side. Okay, rent in advance. Rent in advance. Accrued income, right? Accrued income. 200 rupees should be in the liability side or credit side. Capital should be adjusted. So the capital balance being 6,000. Now this capital 25 is the debit balance, so it should be subtracted, right? It should be subtracted. And here also we have another capital 360 the credit side. Credit side means it should be added. Now after doing these two adjustments with the capital, now the new capital balance being 3,335. Am I right? Verify this. 3,335. Next, interest on drawings. A new account comes in the credit side. 6,000, right? Okay. 6,335. Okay. Capital is now 6,335. And interest on drawings in the credit side. I put the value in the credit side. Interest on drawings. This value be interest on drawings 25. 25. And then interest on capital. That should be the debit side, right? So interest on capital. This value being 360. And depreciation should be debited in the trading account, trial balance, sorry. Trial balance debit side 200. And that reduces the fixed assets value. Fixed assets by default debit balance. No. So now the fixed assets in the credit side, it should reduce the value. So it's not 4,000 anymore, it's only 3,800. Outstanding interest on investment. So outstanding interest on investment. Okay. This balance being 140 in the debit side. And interest on investment should be the credit side. So interest on investment. Credit side of the trial balance, the value being 140. The value being 140. And interest on loan in the debit side. So interest on loan. Interest on loan. This balance being 100. As well as that becomes a liability to outstanding interest on loan. Interest on loan. This value being 100. After so much of adjustments, if you tally the trial balance, that will be the adjusted trial balance. That will be the adjusted trial balance. Come on, get me the value. 19,900. 19,900 is the total of the trial balance. So from this, it is very clear. If we are aware about these details much ahead before the preparation of the trial balance could have been this way. Okay. So we don't have such a trial balance because we were not aware about all these things at the time of preparation. Now we adjusted that. We will prepare the final accounts now. Trading and P&L account. Trading and P&L account. Trading and P&L account. And then balance sheet. And then balance sheet. Right. I'm going to post all these things. Debit side, purchases, where will it come? In trading account, debit side, so purchases, 2 purchases. This value being 3,000. You can join with me solving this illustration. Carriage in. It's an item of trading account, should be debited here, so carriage in. This value being 1,000. Admin expenses should be debited in the P&L account. Admin expenses. The value being 600. Selling expenses should be debited in the P&L account. So selling expenses. 1,200. Fixed asset should be posted in the balance sheet. Fixed assets FPA. 3,800. 12% investment, 2,000 rupees. Asset side, 12% investment. The value being 2,000. Apart from that, we have been given debtors, cash, closing stock. All the three are the assets only. If the closing stock appears in the trial balance, what does it mean? The adjustment entry for the opening stock and closing stock were already passed. After that, whatever the closing stock we have, which is nothing but simply an asset, should be transferable directly to the balance sheet. It will not appear in the trading account. Right? Whatever the items available in the trial balance or any account form should be transferable only to one place. If it is in the adjustment, it should be posted twice. As the closing stock appears in the trial balance, it should be posted only once, that too in the balance sheet asset side. Right? So stock in trade, stock in trade. This value being 3,000, and then drawing should be subtracted from the capital. So capital, from there I have to subtract the drawings minus drawings. The value of drawings here being 1,000, and advance admin expenses. Where will it be posted? Advance admin expenses, real account or personal account or nominal account? Personal account. Will that come in the trading and P&L account? Trading and P&L account are nominal accounts, right? So that will contain only the nominal items, nominal account items, right? So advance admin expenses is a representative personal account, should go to the balance sheet only. So advance admin expenses, I am going to post that in the balance sheet asset side. Advance admin expenses. Okay, asset, this one is an asset for us, right? Advanced admin. This value being 400. Accrued income, Where will it go? Also representative personal account if it is being the debit side and it will be an asset only. So accrued commission. The value being accrued commission 100. And interest on capital. Where will it come? Interest on capital is an expenses debit to the P&L account. It's the company's responsibility to pay the interest to the owner. Also an expenses. Depreciation. Also an expenses should be debited to the P&L account. The value being 200. Outstanding interest on investment. Representative personal account will go to the balance sheet. As it's the debit side, it will go to the asset side. Outstanding interest on investment, otherwise accrued interest on investment. Accrued interest, value being 140. And what about the interest on loan? Interest on loan is a nominal account, expenses debit to P&L account. So here interest on loan. Interest on loan. The value being 100. You have posted all the items given in the debit side to the concerned account. See, yeah, I missed what? Debtors, okay. Debtors and cash, I missed both. So debtors here being 2000 rupees and cash rupees 1000. I have posted all the debit values. The debit side of the trial balance items will be transferable to the debit side of the trading or P&L account or asset side. You should not have any more confusions. If you are posting the other way, other side, it should be a subtractive only. For example, drawings. Drawings should be the debit side. No, it should be posted only in the asset side. But instead of posting the value in the asset side, I am subtracting from the capital in the liability side. That is also accepted. Then, credit side items. Sales, buy sales, the value being 7000 and capital 6335, 10% loan, liability, 10% loan. The value being 4000, and then creditors 1000 liability side. Okay. Commission received, income, credit side. Commission received, and simply commission 600. Rent 200. Rent 200 and interest on investment also income in the credit side of the P&L account 100. Outstanding selling expenses, come on, it's a representative personal account, will go to the liability side of the balance sheet. So outstanding selling expenses, the value being 200, and rent in advance, also liability. We have received our income in advance, we are liable now. Rent in advance, okay, the value being 200. Interest on drawings, income, right? So owner has taken the money, but then owner has to pay the money to the company. This is the income of the company. Interest on drawings, the value being 25, and interest on investment. Interest on investment here is 140. I can add up with this, right? So 240. It's a repetition. So I'll just do this addition there. So the value of interest on investment being 240. Stand correct. Outstanding interest on loan is a liability, will go to the liability side. So outstanding interest on loan. Either you can name this being outstanding interest on loan or simply loan 100 rupees. Now, if I tie the trading account, the GP here being 3000 and I transfer the GP to the P&L account 3000 rupees. Of course, we could have passed the transfer entry also. Already we have seen the transfer entry details, so I don't go for that now. Right, you finish up tallying this to find out the net profit. What's the total of credit side? The total of credit side being 4065. 4065 here. 4065. What's the net profit then? 1605. 1605 should be addable with the capital. 1605. After addition of this, the capital being 6940. Finish up carrying the balance sheet now. The total of balance sheet being 12,440. 12,440. Is that okay? Come on, make a note of it. Rather than in adjustment. For example, closing stock. If the closing stock appears in the trial balance, that's a real account, will be transferable to balance sheet as a set. Outstanding or accrued expenses representative personal account will go to the liability side, credit balance. Prepaid expenses representative personal account and debit balance should go to the asset side. Okay. Accrued income representative personal account and also debit, because the income supposed to be receivable as an asset for you. Debit balance will go to the asset side. Unearned income, otherwise income received in advance is otherwise named as unearned income. Representative personal account, because you have received the collection or money for that you have to work for. You have not worked for, but you collected the money, which is called income received in advance, otherwise named as unearned income. You received, but you have not earned. Earned means you have to work for that. I collected the fees from you, but I have not completed my coaching. That means I have not earned that fees. Collected the money, but not earned, which is nothing but income received in advance. Representative personal account and credit balance will go to the liability side. Depreciation, value loss of an asset. So nominal account, debit and debit to P&L account. It should be debited to P&L account. Bad debt also nominal account, debit to P&L account. And provision for doubtful debts. It's a provision, not confirmed one. Amount or the profit kept aside to meet the bad debt loss is just a provision similar to the reserve, will be posted in the liability side. It's a credit balance. So always remember the provision for doubtful debts should be credit balance only, because it's not a loss. Okay. The later period there may be a loss in the name of bad debt. That bad debt will be adjusted in this provision for doubtful debts. Right? The loss may be debit now. By the time the debit is adjusted in this credit balance. There's slight difference between reserves and provisions. Provision is a known expenses. For that, if you are creating an amount as a reserve, that is called provision. Otherwise, if you don't have any such commitment to be debited the P&L account, those things will be named as reserves. Okay, it's only a profit. Profit could be used for any purpose. Discount allowed and expenses and debit to P&L account, and provision for discount on debtors. Okay, also a credit balance. 8 and 10 both are same almost. 8 and 10 both are almost same like liabilities. Discount received, credit balance. Income. Okay. Reserve for discount and creditors. It's a debit balance. It's a inverse of this one. Okay, inverse of this one. Provision for doubtful debts and provision for discount and creditors are same. Provision for discount and creditors is inverse of these two. So asset account. Interest on capital, nominal account and debit to P&L account. Interest on drawings is also nominal account, credit to P&L account. Is that okay? Keep this point in your mind. And depreciation also. So whenever the adjustment items appears in the trial balance, it means the double entry for that adjustment is already over. You don't need to worry about that. Hereafter, those things will be posted only once to either trading and P&L account or balance sheet. In this question number 3, we are going to deal with some typical illustrations, typical adjustments. So we'll try to finish up the adjustments first of all. After passing the adjustment entry, we then proceed with the trial balance. As such, now I don't want the trial balance anymore, so I'll keep the adjustments as a base to proceed. We'll post it later. Okay. Now, adjustment number 1, stocks were lost in fire extent 500, which was insured and insurance claim was admitted for rupees 400. The loss of stock in fire extent being 500, so you have to pass the entry for that. And also it was insured, so you will be receiving the claim of rupees 400. So you have to pass 2 entries. One is for abnormal loss, another one is for the due for insurance claim. Yes, come on. Pass the entry for abnormal loss. What is the journal entry for abnormal loss? Come on. Huh? See, you can either do this way. Abnormal loss account debit or loss of stock in fire accident account debit to trading account. Okay, and then profit and loss account debit to abnormal loss, or you can club these two entries to abnormal loss. Is that okay? Rather than debiting to the abnormal loss, you can debit the purchases also, because stock is usually named as purchases or sales. Okay, whenever stock other than for the sale purposes used or lost will be debited or adjusted only in the purchase account. Okay, so rather than you debit the abnormal loss, or you can debit the purchase account, and ultimately the same loss should be debited to the P&L account also. You have to pass 2 entries, or you can club these two into single entry, where the entry being P&L account debit to trading account. That way also you can pass the entry. This is the entry for abnormal loss. The value of the abnormal loss here being 500 and 500. 500 and 500. And it is insured. So as it's insured, we can claim the money also, the loss of fire extent. So we will supposed to get 400 rupees. As it's only outstanding, not received, it's only admitted. So admitted means the insurance company has accepted to pay 400, we have not received. So the entry being outstanding insurance claim like. So insurance claim is a benefit for us, and outstanding insurance claim is an asset for us. So outstanding insurance claim account debit, outstanding insurance claim account debit to insurance claim. Insurance claim. The value being 400. The value being 400. First one is over. Second one. Goods were sold on sale or approval basis for rupees 500, on which customer's approval still pending was rupees 300. Mr. X marks up at the rate of 20% on cost. Okay, marks up at the rate of 20% on cost. Now, let me explain this logic first of all. I make a sale, okay, the trial balance of X and customer makes a sale here, while selling cost, and they add the profit, which is the sale price. The profit added in this case is 20% on cost. Whatever it may be after on will be the base. That base should always be 100. And 20% or the 20 is nothing but markup. The markup is nothing but profit. The profit is termed as markup here. The cost being 100, the markup, which is nothing but profit being 20. How do I consider the cost being 100? Any term after on will be the base, that should always be 100. Any term. 20% on sales means the sales should be 100. Okay. You have to be careful with that. So, 20% profit on cost, 20% 20%, right? 20% profit on cost, so sales. If it is 20% profit on cost, profit is 20%, cost is 100 rupees. Is that okay? So cost, profit and sale price. Cost is assumed to be 100, profit is 20. By adding the profit with the cost, you will be getting the sale price 120. Then the relationship among the three being 5, 1, 6. 1/6 of sales is the profit, 1/5 of cost is also profit. Or 5/6 is the cost on sale. That's how you can imagine. In this case, 20 will be the profit, 100 will be the sales. And sales cost plus profit should be equal to the sales. Here sales is 100, profit is 20. Cost is added to the profit rupees 20 to arrive the sales of 100. Then cost should be the missing data. How much it should be? 80. Otherwise, you can simplify this way. For every 4 rupees of cost, profit being 1 and sale price being 5. Or 1/5 of the sale is equal to profit, or 1/4 of the cost is equal to profit. That's how you can think of. Okay, you should not have any more confusions. This will be applicable in most of the cases. Whatever it may be, after on will be the 100. That's the base which is always 100. Okay. So in this case, 20% markup on sale cost is given. That's why the cost is 100, profit is 20, and sale price is 100. 120. Sorry, 120. In this illustration, 500 rupees worth of goods sold, on which customer's approval still pending was rupees 300. Out of 500 rupees, customers accepted for 200. You no need to worry about that. So 300 remains pending. How do I handle this scenario? Just think over. Right. Usually, what happens now on 25th March, the company gives a usage period, a trial period of say a month period. So you can use it for a month. If you are satisfied, then you can use and pay the money. If you don't satisfied, just return it. Okay, that's what about on approval basis, sale on approval basis. If you are satisfied, very happy, keep it with you and settle the money. If you don't satisfy, so return that and you don't need to pay anything. So on 25th March 2022, X makes a sale of rupees 300 rupees. How much? 300. Forget about 500. Out of 500 rupees worth of sales, 200 was already accepted. I am okay with that, so I hold it. To the extent of a sale sold on approval basis, pending approval from the customer side will be treated differently. On 25th it is sold, right? So on sale the there will be being debtors of a debit to sales. Am I right? The value being 300. Now, as per the realization concept, this sales is not realized, right? 1 month is there. By 25th April, if the customer says that this material is not fit for usage, I want to return it. So if he returns on 25th April, definitely what happens? It's not a profit for me. If you are being a sales manager, on 25th March, you make a sales to all of your friends and relatives, to know people, saying that you no need to pay it for, use it for 1 month and later return it. Such a way, the salesperson sells the goods to all. He makes a sales of say 1 lakh. So, 1 crore, imagine that. Big number, 1 crore. He does the sales on which date? 25/3/2022. Stating that what? Okay, if you don't satisfy, you can simply return it. Either satisfy or not, you say that you don't satisfy and return it. That's how the sales manager sells it. And then the profit, because of 1 crore of sales, being 20 lakhs. On 31st March 2022, the sales manager demands the owner, sir, I made a sale of 1 crore. Out of that, 20 lakhs is the profit. Give me my commission. My commission say around 20% on this. So 4 lakhs. So the commission is now taken by whom? Sales manager. The next day, he resigns the job. When he resigns the job? On 1st April, the nice date, right? What is special in this date? 1st April. So 1st April 2022, he resigns the job. April's full. So he resigns, full state. He resigns the job. Exactly on 20th April, all the goods got returned. All the goods got returned. Who is being the person affected most here? The owner. Huh? Isn't it? See, is it the right way of recording? If the sale is there on approval basis, the sale is recognized only on approval from the customer side. Otherwise, this problem will come. In order to avoid that problem, what we can do, as on 31st March 2020 or year end, any sales remains pending from the customer side assumed to be not sold. Assumed to be not sold. It should not be considered as sale. That's the logic. So exactly on that date, okay, on that date, 31st March 2022, this is not sales, you are reversing. So the entry being sale upon debit to debtors. Is that okay? To the extent of approval pending. To the extent of approval confirmed, no need to worry about it. Already realized he has paid that money. To the extent of sale, which is sold on approval basis, still the approval is pending from the customer side, will not be considered a sale as on 31st March. So as on 31st March, this is not considered a sale, means you are simply returning it, reversing that entry what you passed the time of sale on 31st March. On confirmation, probably on 24th or 25th April, if all the customers are confirming, again you can return. Again, data is debit to sale, that's how you can do the remedial journal entry. Okay. Now you have to note it down very seriously. If the goods are on sale or return basis, that sales to be means the approach should be still pending. Now for that reversal entry will be passed. Here just see the entry here being sale upon debit to debtor. Sale upon debit to debtor. To debtor. Is that okay? It's simply reversal. Simply reversal. Clear? The entry doesn't end here. Okay, the entry doesn't end here because how do you find out the closing stock? How do you find out the closing stock? If you are working in a concern, how do you find out the closing stock? Goods purchases, there is a document, invoice is there. Goods sold, there is a bill, cash memo, whatever it may be, go and verify. What are the expenses you spend, and for that you get the receipt or bill. So using that we can confirm. Now my question is, where is the closing stock? How do you know there is a closing stock? What is the value of the closing stock? But where will you get? If you are getting appointed as an accountant in of the company, you are asked to prepare the final accounts. Okay, you immediately ask the manager or the owner, sir, where is the closing stock? I have studied the closing stock only given below the trial balance, sir. How do I know? Here, the trial balance itself prepared by you, no? Then where will be the closing stock? Come on. Where will be the closing stock? Is it below the trial balance or inside the trial balance? Nowhere. Where will it be? The closing stock will be in borrow. Warehouse, right? The closing stock should be in the warehouse only, practically. If you are appointed as an accountant, you might have prepared the trial balance based on all the transactions. How much of stocks remains unsold? You are not aware about that. As an accountant, how do you find out? You just go and verify the stocks available in Goa. This is called physical verification. So if you are working in any of the companies, exactly on 31st March, the company may be shut down or closed. If you inquire about why the business is closed today, then they will tell you it's a stock taking day, sir. Stock taking day is the day for finding the closing stock, which is not physically verifying the stock available as of the date. Comparing with the cost and market price, they will decide what is the value of stock available. It's an event. Closing stock and event. Already we have discussed the difference between transaction and the event. Purchases is a transaction, sales is a transaction. Okay, purchased for 1,000, out of that 800 rupees worth of goods sold. 1,000 rupees purchase is also a transaction. Out of 1,000 rupees, 800 rupees worth of goods sold, also a transaction. Remaining 200 rupees worth of goods remains unsold, right? We don't have any transaction for that. This is only result of the buying and selling. Result of any buying and selling is called event. Okay, gross profit, net profit, all these things again event. Okay, because of the operations, what is the end result? Profit. or loss. So profit or loss both will be the even, and purchased, some of the assets remains unsold, some of the stocks remains unsold, then it is even. Even. How do you find out the closing stock? You go to the godown and physically verify and value that properly, and that's the closing stock. That's how the closing stock is arrayed. Here the closing stock being 3000. Where are you from getting this? You are getting this from godown or warehouse, physically verified. On verification, this stock is missing. Where is that stock? Now the stock is in the hands of the customers. Isn't it? Stock is in the hands of customers. How do you find out the closing stock? Physically you might have counted. While counting the stocks available in the customers, still approval pending means it's not sale. If it is not sales, that stock is mine only, no? Should be addable with my closing stock. Might have been missed. Physical verification also could not be, could not have this item in the closing stock. So now we have to pass the entry for the stocks remains in the hands of customer as my stock. That's my stock, right? Stock is valued at sale price or cost. But what value the stock is valued? Always cost, right? So here the sale of 300 rupees is at the sale price. It means at 120 rupees. What about the cost of this stock available in the hands of the customer? Do the cross multiplication, 300 into 100 by 120, 250. Am I right? 250. So 250 rupees worth the stock. By adding 50, X has sent the goods to customer as a sale, and then sale is pending. So we have reversed that sale. As the sale is reversed, as the approval is still pending, it's not a sale, we have reversed. If it is reversed, don't forget to add the stock in the customer's hand, also my own stock, like should be added. That is not included in the closing stock. Now you just pass the stock entry for the stocks with the customers. What is the journal entry for closing stock? The journal entry for the closing stock is what? Okay, closing stock account debit to either purchases or trading account. In both the way we can write. Now the same way we can pass the entry for the stock in the hands of customers. But already we have the closing stock. This is available in warehouse, right? This 250 is available with the customer now. So I can name this as this way: stock with the customers. Okay, as it is not sale, then that will be my stock. Okay, so the entry being okay, stock with customers, stock with the customers to trading account. Hope so you could understand. This value being 250. 250. Okay. Now, third one, manager is entitled for a commission of 10% profit on after charging such commission. Okay, manager is entitled. So you have to find out the profit and loss account. Prepare the profit and loss account and find out the net profit. On the net profit, manager is entitled for the commission. I am the manager of the business. Because of my management only there is a profit. So give me some commission on that. So we can find out the commission only after tallying the profit and loss account. So until that time I am not aware about that. So as I am not aware about what is the manager's commission, that manager's commission remains outstanding. Now I am going to pass a journal entry for the outstanding manager's commission. Final is later. Okay, third entry. What is the journal entry for outstanding? Manager's commission. Manager's commission upon debit. Still it's outstanding now to outstanding manager's commission. Manager's commission. How much is that? This one. 10% profit after charging such commission. See, whatever the net profit you find out by preparing a trading and P&L account is nothing but net profit before commission, because we are not aware about the commission currently. From there, we have to subtract the manager's commission. After that, what do you get? Net profit after commission you will get, right? Say that if you tally the P&L account, you will be getting the net profit. Yeah, of course, net profit. But what happens? We have not calculated the commission because we are not aware about the commission currently. Only after knowing the net profit of the business, we can find out what is the commission payable to the manager. So, the amount what you get after telling the payable account roughly is called net profit before commission. From there, commission is subtracted. You will be getting the net profit after commission. After commission. Now, let me see here. Manager is entitled for a commission of 10 percentage. 10 percentage means 10 by 100, right? On what? Profit after charging such commission. Whatever it may be after on will be 100, right? The commission is 10. It means commission is 10. Now my question is whether net profit before commission is 100 or net profit after commission is 100. Yeah, after commission is 100. From the net profit before commission, 10 rupees is subtracted to arrive the net profit after commission. Then what could be the net profit before commission? 110. If you are aware about the net profit before commission, you can do the cross multiplication to get the rest of the things. As I am not aware about the what is the commission payable to the manager, I just pass the entry. Calculation could be done later. Okay, calculation could be done later. Fourth one. The following transactions were omitted while preparing the trial balance. Goods were taken by the owner, drawings, and goods were distributed as sample and advertisement expenses. Goods were contributed to a child welfare trust at free of cost, donation. So we can pass all the three routed through the purchases account, right? So debit the concern part, purpose for what it is used, and credit the purchases account, right? I can pass a combined entry for all these three items here, right? Let's see here. For the purchases taken, goods taken over by the owner account is debited, otherwise named as drawings. So drawings account debit, and given as a sample, then donation account should be debited. Donation account debited, and sample advertisement, right? So this is advertisement, and the donation should be debited. Donation should be debited. The value being 50, 25, 25, and collectively it should be charged to purchases account. The value being 100. So we have passed the adjustment entries completely. This illustration is all about special type of adjustments. Special type of adjustments. Now let's see here. I am going to incorporate the trial balance and then prepare the final notes. Right. I just erase this. Wanna copy this? Okay. Now, let's see. Trading and P&L. Trading and P&L. Trading and P&L account and balance sheet. Trading and P&L account and then balance sheet. Purchases should be debited in the P&L account. So trading account. So purchases, 2 purchases. The value being 3000, and we have purchases in the credit 100 should be adjusted. Finally, the purchases being 2900. Carriage in, no adjustments. I just post that in the trading account. The value being 1000. Admin expenses 600. We don't have any expenses adjustment. Admin 600. Selling expenses selling expenses. Okay, the value being 1200, you can add that advertisement being the selling expenses like 1225, or you can put the value in separate way also, accept 1225. Fixed assets 3800, fixed assets 3800. 12% investment asset, 12% investment. We have to verify the hidden adjustment if the date of investment and dates also given. Okay, anyhow we have already adjusted. So for 2012 percentage being 2240, already the interest on investment given here being 240. Debtors, cash, closing stock or the assets will be transferable to the balance sheet. So debtors 2000, debtors 2000, cash 1000, and then closing stock 3000, and drawings should be subtracted from the capital minus drawings 1000. There is one more drawings, right? 1025, so 50. I'll add this one also, this 50. So 1000 plus 50, 1050 can be subtracted. Advance admin expenses and asset. In the asset side, advance admin expenses, the value being 400. Commission receivable also on asset, commission receivable, the value being 100. Interest on loan expenses debit to P&L account, the value being 100. Here the loan is also there, 4000, for that 10% is 400, but the borrowing date is only 1/1/2015 to the year end 31st March. Only 3 months are there. So this the trial balance is for the year end 31/3/2015. 3 months interest being 100, so it's matching, so no need to adjust anything. Outstanding interest on investment also an asset. Outstanding interest on investment. This value being 140. This value being 140. Interest on capital should be debited. Interest on capital should be debited. The value being 360. Depreciation should be debited 200. Depreciation should be debited 200. Now, credit side, sales 7000 requires adjustments. Am I right? Here is sale debit 300. Approval, pending approval, no, it's not sales, it should be reversed. So now the sales being 6700. Capital 6335, and loan being 4000, 10% loan 4000, and then creditors 1000, commission income in the P&L account, commission, the value being 600, rent 200 rupees, rental income, interest on investment 240. Outstanding selling expenses outstanding selling expenses, liability 200 rupees in the liability side. Rent received in advance also liability. Rent received in advance, liabilities. Outstanding interest on loan, also liability. Outstanding interest on loan 100. Interest on drawings revenue. Interest on drawings, P&L account. Interest on drawings. The value being 25. And leftover items. Abnormal loss, debit, credit gets eliminated. So from this it is very clear, in trading account it is going to be debited and P&L account is going to be, in trading account it is going to be posted on the credit side and in P&L account it is on the debit side. Stated this being EAL, abnormal loss, 500. Abnormal loss, 500. Outstanding insurance claim, an asset for us, so outstanding insurance claim, asset side, the value being 400. Insurance claim, revenue, put that in the credit side of the P&L account, insurance claim, the value being 400. And debtors should be adjusted, right? So 300 should be subtracted. It's not 2000, it's only 1700. Originally 2000, where one of the sales still pending, on reversal, the debtors balance is reduced by 300, right? Stock with customer. Stock with customer should be in the asset side. Stock with customer. Okay. The value being 250. Did I write the closing stock?
Stock.
3000. Yeah. Stock with customer. And in trading account, in the credit side, stock with customer. The value being 250. See, the stock with customers treatment is just similar to the closing stock. What do you do in the case of closing stock? Post that in the credit side of the trading account and record that in the asset side of the balance sheet. So I posted that in the asset side of the balance sheet and recorded in the trading account's credit side, or it can be subtracted in the purchase account also. That's your choice. And manager's commission should be debited. Manager's commission. And outstanding manager's commission, a liability. Outstanding manager's commission. We have to calculate. And drawings also already adjusted. Advertisement account also adjusted. Donation should be now adjusted. So donation. The donation here being 25 rupees. Donation 25. Now finish up telling the trading account. What's the total? 7,450, right? 7,450. 3,550 is the GP. Transfer that here, GP being 3,550. Without knowing the manager's commission, we cannot do it. But we can find out the profit here. Okay. I'll just write this here. Donation and manager's commission. Manager's commission. Manager's commission and net profit. What is the total of credit side?
5,015.
5,015. 5,015. The balance what you get is nothing but amount meant for the manager's commission and then the net profit after manager's commission. What is the balance we are getting now? Make it faster. 2005, am I right? This is 2005. This 2500 is 5 rupees is nothing but net profit before commission. Net profit before commission. It means this 110 share. Then how do we calculate the commission? Commission is nothing but on that into 10 by 110, isn't it? Do the cross multiplication. 10 by 110. 10 by 110 of 2005 being the manager's commission. How much is that? 182, I think so. Balance, that 182 should be posted twice. Right. Balance will be the net profit 1823. Should be addable with the capital net profit 1823. The final value in the capital account being 7108. 7108. Now finish up tallying the balance sheet. Hope the total being 12,790. 12,790. Is that okay? Now finish up copying this.